Hello and welcome to BQ Prime, giving IPO Adda, and my company focus is Aether Industries. It's a specialty chemicals company based out of Surat. The company is coming out with an IPO on May 24th and that IPO closes on May 26th. Price between 610 and 642. The fresh issue comprises of 627 crore shares and offers of 181, taking the total issue size to 808 crores. The company also did a pre-IPO print that's at 642 to some of the investors, raising 130 odd crores. And joining me is Aman Desai, who is the whole-time director at Aether, and Faiz Nagariya, who is the CFO at Aether. Starting with Aman. Aman, you're raising around 627 odd crores. What is the purpose of this raise?
I'm sorry, can you repeat that question, Sajid?
What is the purpose of this raise? 627 crores?
Multiple. We are going to remove the debt of the company. We're going to finance 2 new Greenfield production sites and general corporate purpose as well.
Okay. Just wanted to understand, you are setting up a new Greenfield project. What is the kind of chemistries which are going to come in that? And what are the products which you're looking at from the new Greenfield project?
Yeah, in the new Greenfield project that we are hoping to commission by the end of this year, calendar year, we are looking at enhancing our existing core competencies of organometallic chemistry, Grignard chemistry, hydrogenation chemistry, and catalysis, to speak of a few. And then the products that we are launching are 5 of them. They are being made they have been developed by us for the first time in India, and they will be made by us for the first time in India, and they are generic advanced intermediates for 5 different pharmaceutical APIs. And so that is the current of the.
And are these going to be exclusive to you, because you have only one chemistry exclusive as of today, right? So will these be exclusive chemistries that you're going to make?
The products that we will make will be exclusively by us. In all the products we make, we are usually the only ones in India. We only pick the products where we are the first one in India. And so the products will be completely exclusively by us. There is no other competition for these 5 products that we're launching in this year. And the chemistries are more of an ocean, right? And so a lot of people can practice these chemistries, but in terms of the products, they'll be exclusively done by us for the first time.
Faiz, take me through what is the kind of margins which are there in these products, given the fact that these are exclusive products and ideally the margin should be much higher.
Right. So actually our business, we have these 3 business models: the large scale manufacturing, contract manufacturing, and CRAMS. So our products fall within these 3 business models. So large scale manufacturing is the model wherein we have a EBITDA margins of around 27 to 28%. The contract manufacturing is again 28% to 29%, and CRAMS is the business where we have a margins with 70% plus.
Mm-hmm. So
on an average, it is up to 29% currently.
29%. So, is there enough headroom for you to take the margins up, given the fact that you have CRAMS which is 70% up and others are 28, 29%? Is there enough headroom for you to take the margins higher there?
There is headroom, yes. In terms of the products that we are going into more value-added products consistently. Our average price per kilo in the last year was 1440 rupees per kilo. With the new launches happening, we are looking at increasing that average price per kilo even further. In terms of the contract manufacturing opportunities, there is significant headroom for growth, yes.
What about the fact that you have supplier agreements in place for 3 to 5 years and it is formula-based pricing? How does pricing work?
In terms of, it's different for different customers. In the large-scale manufacturing model, where we sell advanced intermediates for the first time in India to multiple customers across the world, the contracts are range from multi-year contracts to single-year contracts to even quarterly contracts and quarterly purchase orders. And so at the end of each contract, each purchase order, there's a price revision that takes place as per the competitive landscape. In the contract manufacturing business model, it's more of a multi-year supply agreement with formula-based pricing of raw material costs, production costs, and overheads and margins. And so it's more of a transparent working model in the contract manufacturing business model. And so that's how the pricing works usually. And it's usually flexible, and it depends on customer to customer and project to project.
Faiz, what about the raw material cost and supply chain issues? In the sense, last 1.5 years, we've seen that raw material costs have gone up tremendously in the last few quarters, and supply chain has also very constrained, leading to higher costs for freights and others, which is there. How do you price that into your model, and how do you ensure that your margins are secure? Is there a way to pass on this increase in pricing to end customers as part of your contracts?
Yes. So we in the last year when the pricing increased for the raw materials, we were able to pass on this pricing to the customers, and the customers happily accepted it because they were aware about the worldwide scenario. So it was not a problem. And going forward, also the pricing model, so the model which we have designed is taking care of the inflation which might impact us because of the raw materials pricing. Freight cost also, of course, we have factored in, but freight cost is something which cannot be passed on directly to the customers. It takes time, but the raw material pricing is definitely passed on to the customers as and when it is increased.
Is there a lag between the time you incur the cost and when the time you recover the additional pass on cost from the customers?
It's maximum 3 months, not more than that.
So,
yeah. About 4 to 6 months, and so that lag is covered by the existing inventory that we have placed, which is in excess planning.
Okay.
As well. And so that lag is kind of balanced out by the existing inventory and the stock that we have.
It's been a usual practice by the company to put inventories of raw materials for at least 4 to 6 months in hand, so that any situation coming out like this, we are able to get to the customers with the current pricing and then gradually increase the pricings. So it does not impact our profit margins much.
What is the kind of inventory levels that you carry in this business, considering that you have multiple headwinds come in? So do you carry sufficient inventory in place for this? Because you mentioned that the inventory covers up for the pricing transmission that happens to the customer. But how does it? Or how many days of inventory do you carry for typically any customer?
So for the raw materials, as I told, we carry inventory of 4 to 6 months. For the finished goods, the inventory is only for 15 days or 1 month maximum. But the work in progress and the other recoveries is between 1 month to 2 months. So we manufacture the products based on the customer requirements. So we have the products ready in the semi-finished part, and then when we get the orders, we complete the finished goods and dispatch to the customers. Main part is the raw material part, because that is to be with us to cater to the customers.
Mm-hmm. What is the kind of current debt that you have in your book? Because at the end of December there was a debt, but has it been fully paid with the funds you raised as a pre-IPO placement, or because you plan to use 138 odd crores of the funds for debt repayment? Once that happens, what is the kind of debt which will be there on your books?
See, basically, once we have the IPO done, we will be a debt-free company. We'll be paying off all our term loans, and we'll be zeroing down all the working capital loans. So once we have the IPO proceeds, we will be a debt-free company. And then, if required, we might take debt if required only. Otherwise, we will be very much in a good position to use the money which will be raised from the public, because we have planned out in that way. Because GCP is also a good portion which will be getting.
What is the normal working capital cycle for you? Because you're using nearly 165 crores for working capital. If I was looking at the borrowing breakup, your current and non-current were almost 50-50 kind of, which was there. What is the normal cycle of working capital which you carry with you on your book?
90 days to 120 days, not more than that.
Okay, and this use of proceeds will help you reduce the cost on the working capital as well.
Definitely, because we will be having funds to use in the working capital, so we will be able to pay off the creditors much more on time, and we'll be able to take benefit of getting more discounts or rebates from them.
Aman, your company started off in 2017, I think, first phase. It's relatively very young company compared to other specialty chemical companies in India. What is the kind of growth that you foresee? Because you mentioned that you've been growing at a very high digit growth, whereas the industry is growing at maybe less than half of that, if I'm not wrong. Is that kind of growth level of 50-60% which you've been talking about, CAGR growth you're talking about, is that sustainable over the next 2 to 3, 4 years? And do you have enough capacity to meet that kind of sustained growth?
No, that's a great question, Sajid. Basically, we started the company in 2013, and we did R&D only for 4 years. And that formed the base of the company, which was based on core competencies of chemistries and technologies. And so that has helped us tremendously over the last many years that in terms of the growth that we have seen. We started manufacturing at the end of 2017, and as you rightly point out, we've been growing significantly over the last 4 to 5 years. In terms of the future, we do see similar growth certainly possible because we have established the fundamental components firmly in place in terms of our infrastructure. And so in terms of R&D infrastructure, we had this in the updated data that has been already provided. We have 90 scientists as of today, about 60 engineers, 60 to 70 engineers in the R&D today. We have an X infrastructure as of 2 weeks ago. We have doubled the R&D infrastructure last week already commissioned, and we are tripling the R&D infrastructure now in the next 2 months. We have tripled the pilot plant into one of the world's largest pilot plant, what we proudly claim it to be. We have 2 new greenfield production sites coming up, which will represent about 1.5x the production capacity that we have today. And also already provided in the data in the public is the fact that we have already purchased a land bank in another chemical zone, which is 12 to 13 times the land bank that we have currently today for production as a even subsequent greenfield production expansion. And so the infrastructure is significant to begin with, and we have aggressive expansion plans across all 3 fronts of R&D, pilot plant, and production. We are also well diversified in terms of the business models that we have, and so large-scale manufacturing, and contract research. Broadly, right now it is 70-30, and we expect this to quickly come up to balance. We have a marquee customer base across the industry spectrum all over the globe. Our team is quite significantly strong right now, 700 plus team. The average age is 32 years, and so it's a very young, hungry, dynamic team. We have a really unique global business development and technology team in place. We drive from the top within the promoter family with techno-commercial excellence. And so I think all the ingredients are quite well set up by us fundamentally for achieving sustainable, significant growth in the years to come.
So the 2 plants which you're talking about, will the 190 crores which you're raising as part of the IPO be sufficient for the construction and setting up of both the greenfield plants we are talking about, or you would need fresh capital going forward maybe in a year or 2? Because today you're raising about 10 odd %, and your public holding would be around 13 after listing. You will have to reach 25% in the next 3 years. So will that be through enough of fresh capital for your further expansion?
So I would take this question. The 163 crores that we are raising from this IPO, that will be used for the 3rd manufacturing site which is coming up, which is a 190 crores project. For the 4th site, we envisage a project cost of around 240-250 crores odd, and that would be done from the GCP proceeds and the internal accruals that the company will be getting. We'll be financing from that. And currently, we do not plan to go to the market for any fundraise for at least 1 year or 2 years. Go after the 3 years when the timeline is very much near to raise this public money to 25%.
So all the expenses I talked about are going to come from the IPO proceeds, and then the 13-time IPO proceeds and the internal accruals. But then the 13-time land bank that I mentioned, which will be even greenfield production site even after the current 2 sites that we're envisaging. For that, we will need capital, but that is still 2, 3, 4 years away. 3, 4 years away. So.
Okay. What is the kind of cash flows, operating cash flows that you get, and free cash flows that you get on an annual basis, Faiz?
So the cash flow, annual operating cash flows for the company have been in a range of around 150 to 200 crores. That's not an BC, but the free cash flows were always a bit in a lower side because we have been doing capex continuously for our current manufacturing site and our sites and R&D and pilot plants. But going forward with the IPO, our cash flows would be much in better positions.
And you have a formulated dividend policy as of now once you list?
Currently, the dividend policy has been announced, but we have not put anything concrete in that because we are a young company. We would like to go for expansions first, and the public would also vouch, and the investors will vouch that they would also love to see the company grow to a level. And of course, dividends is always on the mind of the promoters and the management. That would be done, but currently the dividend policy is in a not a concrete stage.
Okay, but at some point in time, you will articulate it in some part of what percentage of your net profit would be given away as profits. Your exposure. Sorry.
For dividends, so that has to be done, sir.
Okay. Your exposure to on an industry basis is around 62% for pharma, and agrochem being the same at 23 odd percent, which is there. Do you foresee this mix changing going forward?
Yeah, so if you compare from the last few years, the pharma has been going down steadily in spite of the new molecule launches that we've been having in the pharmaceutical space as well. But the agrochemical has been growing, the material sciences has been growing, and so we do envision, and that is a sustained effort from us is to kind of equalize and divide out the end user applications of our products across the industry segments. And so we do envision the agrochemicals, material sciences, coatings, additives, oil and gas to be coming up in larger proportions, and there are many activities going on to achieve the same.
Mm. What about your exposure to the largest customer? I think it's 13.52% at the end of December to the largest customer. Is this a growing customer for you, or it will phase out and some other customer will come in place of that?
It's a growing customer, but also we are consciously trying our best to kind of label that out as well and make it go under the double-digit number as well. And we already have plans in place for that. And so and if you compare again the last few years, the proportion of that customer content was much higher than what it is now. And our goal is to make that go down even further to reduce any sort of dependency of the company on customer or product or industry segment or region or applications. And so that is the sustained effort across all directions, is to reduce dependency and always be dependent on our core fundamentals, which are the competencies of chemistries and technologies that we envision the company.
I asked that because of the top 20 customers, the revenue contribution is around 73%. So diversification, is that easier said done, because there are only limited number of players in the market, right? So when you say diversification, how easy it is to diversify risk in this space?
It is easier said than done, yes, of course. And if you look at all the customers that we have, most of the customers and the biggest customers are all reputed multinational companies who are at the top of their respective fields and their respective industry applications. And so diversifications in terms of customers is easier said than done, because in a certain business segment, the products that we are making, there are only a few customers out there who are the biggest ones of them all. But diversification in terms of industry application is something that is truly in our hands, and that is a sustained push that we have, as you see the pharmaceuticals going down and the other segments also coming up. And also the effort and the focus in the contract research and contract manufacturing business models is consciously decided to be non-pharma. And so that grow in the material science and the coating additives and the oil and gas. And so that is one of the efforts we are taking to kind of balance that portfolio out and diversify, is to focus these other two business models more towards the non-pharma sectors, which are the agro material sciences, oil and gas. And those are seen by the numbers already, in that the pharmaceutical business is a minuscule component of the contract research and contract manufacturing business models that we have.
How do you see the agrochemical and material sciences growing going forward? I mean, are their growth rates much more faster than the traditional pharma business growth rate?
It's a tremendous opportunity landscape. Pharmaceuticals, India is a significant powerhouse in the pharmaceutical industry and the pharmaceutical world. Not to say there's not opportunities for growth in pharma. There's tremendous opportunities for growth in pharma, but there's many people and many companies who are focusing on that. But and agro as well, to an extent, is also quite prevalent in India. There are top companies in India who are working in this space. We are working aggressively in the agrochemical space as well, in terms of the contract research and contract manufacturing business model. But the non-pharma, non-agro sectors is where I do believe we have established a strong foothold at the topmost technical levels of these innovative companies across the industry spectrum of the oil and gas and the material sciences and the coatings and additives and high performance photography. I think that is a virtually relatively untapped territory by Indian contract research, contract manufacturing companies, and we have now established a firm foothold at the topmost technical levels of these companies across the globe, and I think that represents tremendous growth opportunities for us.
You mentioned in the RHP about the product launches that are expected between FY23 and FY25. What is the kind of a potential upside from those launches which you're trying to undertake?
Probably have to refrain from giving out any numbers, but
Okay, not just don't give me the numbers part of it because I know you're constrained by SEBI regulation. But is it fair to say that the new capacities which have been built will be catering to those products? And when you say that your new capacities will be 1.5 times more than the current capacity, are we looking at revenues also more than doubling or going 1.5 times more in the same period?
it depends on the products. The conscious push of the products, and that is proven by the historical data, is that we are always going to higher value-added products. The average price per kilo has been increasing consistently over the years, and the new product launches that are happening will see that trend increasing even more. We are going in a selection product selection criteria. We had a X revenue model as a selection criteria, and we have kind of more than doubled that expectation now that the products now that we select will generate more than 2x the revenues that what we expected in the early years. The average price per kilo has been going up. The average value and the volume wise, total revenue wise, these product selections are also on the consciously on the higher side, and so we are looking at getting into higher value added products. And but at the same time, then these products are more complex, require more footprint in the production facilities, and take a little bit more time to stabilize and mature. And so the short answer to your question is it depends, but yes, the conscious push of the company and the product selections and the new launches are going towards more value addition and higher up in the value chain of specialty chemicals.
Guys, Aman has put a fairly aggressive growth target for you, and how are you going to manage the cost for that actually? Because you have a global headwind coming in terms of raw material costs, supply chain constraints. Are you hedging yourself enough to not only to match and up your EBITDA margin even as the revenues go up?
So currently, see, we have a natural hedge for our import exports to an extent of around 40 to 50%. For the remaining, we have started hedging. We didn't have the hedging policy initially, but now we have started that thing. And moving forward, we'll be doing more of hedging because we understand that the dollar market has become a very volatile, and we never know how it is going to perform. So of course, definitely that is on the minds. That will be a very big factor for us to control, so that we do not lose out on the product costings, and they should not go out of our reach.
Especially with respect to exports, you export to 18 odd countries, nearly 49% of your revenues are exports. Is that a natural hedge for your raw materials which you are importing from outside?
Because our raw material concentration is roughly 40-45% only.
So it becomes a natural hedge in that sense for you, and you're able to pass on any additional price advantage to your customers if there is any which is coming because of that?
So currently we are just trying to match the pricing of the competitors like China. We do not want to get into a position where our customers should then be in a position they're asking for reduction in price. So we are trying to be at par with Chinese prices.
In the
Yes.
And what is the kind of differential that you have with the vis-a-vis Chinese prices? Are you at a premium to them, or you are at par with them as you speak?
We are at par with them. So if I'll just give an example, if the raw material pricing is $100, so we bring it in $100, and then whatever is the duty cost and the freight cost, everything we add it to it, and we sell it to our customers in India and other places.
So we match the landed
cost
of the competition into India and the non-landed cost elsewhere in the world. And so the goal is not to take the pricing, the goal is to steady the market and be an alternate, reliable, trusted supplier in a stable region of like India, which is now fast becoming the obvious destination and the preferred destination worldwide.
What about the fact that you do cater to the domestic market, and in the domestic market you have Dr. Reddy's, Divi's, and UPL as some of your customers? How is the domestic market growth? Is it growing as fast as the global markets for you?
So that depends on the product selections that you end up making, whether the products have more demand in the domestic market or in the global market. But so the customers that you see on the RHP, which are actually the fourth of our customers because only they could give us consent, but it's already a significant list, I believe. I think they are the top customers in India, and they are They have these top customers and top companies in India, the ones that you named, have very firm growth plans in the future. And so we see those as very stable, rock solid relationships that we have and that we have nurtured over the last 4-5 years now. And we expect them to continue to grow. And we also expect the global demand to grow as well. And then as we try and balance out our portfolio in terms of the products and the industry segments, these will kind of go up or go down as per that. But some of these main customers that we have are here to stay and they will continue to grow.
What about the breakup of revenue between exports and domestic revenues? Is it going to be 50-50, which is currently the case? And while there is natural hedge for the global customers because you're buying raw material and selling them finished products, for domestic, are you able to pass on the cost to them easily, and are they able to absorb the cost easily?
So in terms of the balance between the domestic and global, I believe it has become 50-50 now. Earlier on, it was more domestic. And so it's become 50-50 now, domestic and export. I think the export might go up a little bit in the next couple of years, but we'll try and balance that as well and have an equitable balance there. In terms of passing on the costs impacts because of the global scenario and the worldwide parameters, yes, for the most part, we've been able to pass on the price impact to our customers because we are in key advanced intermediates and key starting materials, and these are and we are the only ones in India. And so I think there's a weightage that is given to that by our customers, and they have been kind enough to kind of take up the impact that we have faced. And for the most part, we have been able to. There are some, of course, where it's a continuing battle, but that's the case in all businesses.
Aman and Faiz, it's a pleasure talking to you today. The Aether Industries IPO, which opens on May 24th and closes on 26th, is priced between 610 and 642. They made a pre-IPO placement at 642 to some of the investors. The current issue is of a size of 808 crores, giving it a market value of nearly 8,000 crores at the upper end of the price band. Thank you very much for watching B2 Prime.
Thank you, Sajid. Thank you very much. It is our pleasure.
Thank you.
Thank you.